Perhaps the most important aspect of running any organization is how do you finance its operation? Well, today we have a special guest that will provide insight and recommendations around exactly how organizations, large or small, can properly leverage financing options available to them in order to help grow and expand their business. And some of those options just might be right under your nose. Next on this episode of The Savvy Report. Hello everyone, and welcome to this week's edition of The Savvy Report. Today we have a special guest, MacRae, Vice President, Business Development with Express Business Funding. Anne, thank you for joining us. Please tell us a little bit about yourself and the primary focus of your career and your background.
Hi, Ernie. Okay, well, thanks so much for having me. I'm currently the Vice President of Business Development for Express Business Funding in Canada. I've been in the factoring, purchase order financing, alternative lending space for the last 13 years. And prior to that, I had my own business. So I come from a pretty unique background in terms of having experienced firsthand some of the struggles that entrepreneurs face when looking for financing.
Share with us a little more detail about Express Business Funding, or EBF as you're known, and what you actually do.
Sure. We are a Canadian factoring, asset-based lending, and purchase order financing company. We're located in Burlington, Ontario, just outside of Toronto. We've been in business for 17 years, and we provide financing to small and medium-sized businesses in Canada. Our clients are Canadian registered businesses, but we will finance both their Canadian and American accounts receivables and purchase orders. We really focus on helping those small, medium-sized growing businesses that are struggling to find traditional financing.
Give us some detail around why it's important for organizations to have various solutions at their disposal in order to help fund their business and their operation.
Sure. Well, unfortunately, when a business is growing and it needs business, or if it's struggling, usually its first stop is its traditional bank. Unfortunately, the U.S. Federal Reserve just published a study not too long ago that showed that less than 53% of businesses that approach their bank are successful in securing all the funding they're looking for. And even worse, for small businesses, those businesses that have revenue of less than $1 million, less than 33% are successful in getting the funding they need when they go through the traditional bank channels. So there's huge need and demand for alternative sources of funding. These are great businesses, great opportunity, the backbone of the economy, but unfortunately, sometimes they just don't meet all the boxes that the traditional banks require in order to finance. Alternative lenders, such as factoring companies, they're more focused on the business, the quality and the quantity of a company's receivables versus on the company's balance sheet. So they can often work with companies that maybe are too new to be of interest to the banks, too small, or perhaps they do have some financial challenges, so their balance sheet isn't what the banks require, but they still have a great growing business. So that's really the space that the alternative lenders fit and fill a need for.
Now, just a little while ago, you mentioned something about if companies are in trouble in relation to when financing solutions should be considered. But in reality, creative lending or funding is not just for organizations that are quote unquote in trouble, but it's also a useful tool for organizations that are healthy, isn't it?
Absolutely. So I always say our clients always fit into one of three categories. Number one are relatively new businesses. So generally, when you're looking for financing from traditional sources, they may require 2 years financial statement. Well, if you've only been in business for 6 months, How are you going to be able to meet that need? So alternative lenders are a perfect fit for those new businesses they have a great business, they're growing, they just don't have the track record yet. The second group are those that maybe qualify for traditional banking, but they're just growing too fast. So again, traditional lenders tend to look at, well, what did you do last year? Okay, that's the base they work off. They're not looking at what are you going to do next year and the year after that. So it's a perfect option for very rapidly growing customers that, maybe they'll get a $200,000 line or $500,000 line from a bank, but within 6 months, that's just not going to be enough to meet their needs. The third group are those businesses that, for whatever reason, maybe having a bit of a challenge at the time, and they just are struggling to meet the bank's criteria. So really, the alternative lenders really fit into usually one of those three buckets. Primarily, the new businesses and the fast-growing businesses are the best suited for alternative lenders.
So, talking about the challenges some of these organizations face, what do these challenges look like, and what's your experience in terms of how organizations should try to solve them? But also, what solutions are more attractive, and what are the drivers that make them more attractive?
Well, number one, to be attractive, it has to be flexible and it has to meet the needs of the client. So certainly, again, you have to have an option, that will grow with you, that is flexible if you have a seasonal business. If you're looking for a one-stop shop, then that's not going to be a great solution. I think what the alternative lenders, such as factoring companies such as EBF, is that we offer customized. Because we're smaller, we're nimble, we can often customize the financing to meet the specific needs of the company. So for instance, if it's a factoring company such as EBF, we don't have a set limit. So as your receivables grow, the amount available grows. So you're not set, okay, you have a $500,000 line, that's it. Don't come back for another year, you have to reapply, etc. Today you may have a $500,000 line, business grows, tomorrow it can be an $800,000 line. I always tell the story of we have a factoring client who started with us, started as a small business, self-funded for the first 3 to 4 months, but he grew to the point where he could no longer self-fund. He's too new, he wasn't eligible for bank financing. We started with him with a $300,000 factoring line. Within less than a year, it's up to $1.2 million, and it's likely to surpass $2 million by the end of 2018. Perfect example where it's a flexible facility that can meet his needs as he grows, can also meet his seasonality needs.
A key metric for supply organizations is making sure their DSO, or days sales outstanding, is as low as possible, or as low as makes sense operationally for the organization. How does factoring or any form of financing help an organization actually reduce DSO?
Okay, well, certainly one of the biggest challenges I see smaller organizations having is dealing with extended payment terms. They may be selling to large corporations that set the rules of play. According to a 2017 study by Atradius, the credit provider, almost 50% of all B2B sales are done on credit terms, and almost 50% of those payments are late. So small businesses are dependent upon large buyers for payment terms, and we're seeing payment terms being extended. The typical net 30 is gone. Euler just put out a new study that showed in North America, the average days outstanding is 57, I believe it's 57 days. So in effect, small businesses are being forced to provide free financing to large corporations. So that's one of the things that factoring addresses, is that instead of a small organization being dependent upon their buyers to determine when they get paid, when they factor their receivables, they determine when they get paid. So as soon as they issue an invoice, they can get paid within 24 hours. Or if they don't need the funds until the end of the month, they can then factor the receivable at the end of the month. So they're in complete control about when their invoices get paid, as opposed to giving all that control to their buyer.
There is sometimes a perception, and not justly, that factoring is for organizations that appear to be in trouble. Why has that become sort of a misnomer? And what's the actual truth around using factoring as one of several possible funding solutions?
Right. Unfortunately, traditionally, there is the perception that companies that factor may be in financial trouble. It's certainly not true. Most factoring companies, again, are working with fast-growing companies, so it's a sign of strength. Regardless, there still is that perception. There's also, we come across companies that simply because of they don't want what they perceive as extra work, will not redirect payments to a factoring company. Certainly one of the solutions, and what EBF is a leader in, is what's called non-notification factoring, and that's growing in the industry. That's where a blind account is set up, so the customers don't need to know that their supplier is factoring, and they don't need to direct payments directly to a factoring company. So that seems to be a good way where a lot of companies are getting past that perception that for some reason if you're factoring you're struggling, when again that isn't the case. It's generally you're factoring because you're growing so rapidly.
Talking about growing rapidly, there are a number of new fintech solution providers in this space. New companies popping up, it seems, almost every week. Some organizations looking at these new providers as, this is the new silver bullet. And then next week, here's another new silver bullet over here. I've always been a proponent that good variety and choices are good for the market. What's your perspective and your opinion about different solutions being available to organizations, and is variety actually needed?
Okay, well, first of all, in terms of my opinion of fintech, to me, fintech is just the use of technology in terms of developing the customers, underwriting, whatever process that you want. All businesses evolve. Technology has allowed all businesses to evolve. So every company, whether you're defined as a fintech or not, is using more technology than they did last year and the year before. EBF, we wouldn't consider ourselves fintech, but we're certainly taking advantage of all the technology that is there. So I always question the misnomer of the word fintech. They're using technology to underwrite, but hopefully the fundamentals of credit haven't changed. And I think there's been lots of well-known stories of companies that, for the sake of speed perhaps, or whatever, have moved away from the fundamentals of credit, and they've run into some trouble. So first of all, fintech is, to me, just another tool that companies are using in order to provide, in the case of fintech, to provide lending to companies in the most efficient and hopefully the most stable way. And I worry that some of the rush into fintech might be moving away from the fundamentals of what they should be looking at in terms of credit. That being said, organizations are always better served by choice. So certainly fintech has a place. Right now, the majority of the fintechs are definitely serving the smaller end of the spectrum. So they may be a good option for businesses that need generally a small amount of funding, a simple, usually under $100,000 loan. The reality is, as a business grows and its needs become more complicated, the amount of financing they need becomes larger. They're probably going to outgrow the fintech space. So fintechs can't look at asset-based loans and start evaluating other assets. So really, I think the market is well served by having lots of options. So small micro loans, probably it is most efficient to do those strictly online based. And then you move through the spectrum to factoring companies, asset-based lenders, hedge funds, and it goes on and on until you move up the market. So a market is never underserved by having lots of options.
So Anne, in closing, what advice would you share with organizations that are looking for reliable and creative ways to help fund their business or their organization?
Well, Ernie, first I'd say start the process early. You want to be organized and applying for financing well before you really need it. The last thing you want to do is be scrambling to try and find financing when you're at a deadline. Payroll is at the end of the week. Tuesday is not the day to start looking for financing. So by preparing well in advance, getting everything organized, it also allows you to shop around and get the best option. So that would be first, my number one is start the process early. Number two is before you start looking for financing, understand how much you need, why you need it, and be able to clearly articulate what the funds will be used for, how it will grow your business, how it will affect your bottom line, and how will you pay it back. So that's a critical thing. Thirdly, have all your supporting documents organized and ready to go before you apply for financing. You should have your most recent financials, your articles of incorporation, your accounts receivable, and your accounts payable. And then if you approach a financer and they ask for more information, respond to them promptly. It gives the lender a sense of confidence that you're organized, you understand your business, and that you are going to be a person that they can depend upon to live up to the commitments of the loan. Fourthly, and I always emphasize this, is you want to avoid surprises. If there is a problem or there's an issue, be upfront about it. Explain to the lender the situation, why the situation happened, what are your specific plans. So for instance, you have some tax arrears. Don't try to hide it. It's going to come out. Be upfront about it. Explain the situation. Have a plan on how you're going to address the situation. A lender will not, the trust will be broken if the lender finds out after the fact, and it's not going to be approved. The loan won't be approved regardless. And finally, and most importantly, number 5 is look beyond the traditional sources of the banks. For instance, look at alternative lenders such as factoring companies, asset-based lenders, purchase order financers, the fintechs. There's lots of options out there. So shop around and make sure that you understand all the components, all the requirements of the facility before you sign on the bottom line. So those would be my 5 suggestions for anyone who's looking for financing for their business.
And thank you so much for joining us, and we look forward to speaking with you again soon.
It's my pleasure. Thank you so much.
Well, that's it for this edition of the Savvy Report. We hope you enjoyed our interview with Anne MacRae of Express Business Funding, and we'll see you again real soon.